Equity Market Update, September 2022. Indian equities maintained its upward momentum during the first half of the month, but corrected sharply during the second half and ended the month around 3.5% lower in September 2022. Mid caps and small caps outperformed the large caps. The market movement was impacted by resumption of FPI selling during the second half, risk of accelerated rate hikes by US Fed, elevated inflation across major AEs, hardening in US yields, etc. Most major sectors, barring FMCG and healthcare, delivered negative returns, with power, oil and gas, metals and IT being the worst performing sectors. Most major global equity indices also corrected significantly and underperformed India. FPI sold net equities worth $0.9 billion during September 2022. On a cumulative basis, FPIs have sold equity aggregating $7.7 billion in H1 FY23, compared to being net buyer of $1.2 billion approximately during the same period last year. DIIs, however, turned net buyers and bought equity worth $1.7 billion in September and have cumulatively bought $18.7 billion in H1 FY23. Net inflows to mutual funds in August 2022 stood at INR 15,600 crores and INR 111,000 crores approximately in 5M FY23. Outlook. As on 30th September 2022, Nifty 50 was trading around 18.4x FY24 E-price to earnings ratio. While the valuation multiples are high compared to its historical average, it should be viewed in context of a resilient economic recovery and healthy corporate earnings outlook. The ratio of India's market cap to GDP based on CY23 eGDP is relatively high, at around 90%, but within the range of 60 to 100%, in which it has traded over the last decade. Further, the gap between 10-year GSEC and 1-year forward Nifty 50 earning yield is higher than its long-term average. Moreover, corporate earnings growth is likely to normalize from FY23 onwards. Thus, on an overall basis, market appears somewhat reasonably valued. Moreover, the valuations gap between the current valuation of many sectors have reduced compared to their long-term averages, and valuations for major sectors are close to or higher than long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. Optimistic domestic growth outlook, steady corporate profitability, growth supportive policies, etc. bode well for the economy and equity markets over the medium to long term. Accelerated monetary policy tightening, sharp increase in US yields, elevated inflation, slowdown in China, sustained FPIs outflows, etc. are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.